If you gave me $100,000 today and told me, Alex, invest this as smartly as possible for the next few years, I wouldn't put it all in one place. And I definitely wouldn't just let it sit in. Because right now we're living in a very specific moment. Currencies are shifting, interest rates are reversing, global capital is moving, and real estate markets are no longer moving in sync. In this video today, I'll show you exactly how I would deploy $100,000 today, combining Dubai real estate, selective property markets, leverage where it actually makes sense, and add a layer of protection where it matters. I'll walk you through high growth, moderate, and lower risk scenarios using real numbers, not theory. I think that's a really good way to start this new year of 2026, make some fruitful investments, and enjoy solid growth in the years to come. So with that, hit the thumbs up button, subscribe to see more of these videos, and let's get into the video. Before we talk properties and strategies, we need context. Let's look at the global macro snapshot. The US dollar has already shown moments of weakness against other major currencies. The UAE dirham remains pegged to the dollar, which gives foreign buyers with euros or British pounds a competitive advantage. Capital is rotating away from overhyped and overpriced Western cities, and it's going toward yield-driven markets. After COVID, many understood that cash flow is king, and if you can combine a cash flow property with some potential for capital appreciation, that's the best strategy. However, let's give the global cities a reality check. First, let's compare London, Paris, and New York. 3 to 4% gross yields, not even net, heavy taxation, and very high entry costs. Those cities, while very attractive to many investors, are mainly now considered for capital preservation, not really appreciation or yields. On the contrary, Dubai has around 6 to 8% yields on ready stock, and that's actually net. Most importantly, zero income tax and increasing global demand from both residents and also investors, both residing in the UAE, outside, and even remote buyers. That's why Dubai definitely remains a global outlier. So if I have $100,000 and want real impact, Dubai will definitely stay central to the strategy. And while I don't mean that I will only focus on Dubai, I just say that Dubai is definitely going to be a key component of my ongoing strategy. So let's look at the core psychology where 100K really must work. Here's my honest view. 100K is not enough to play ultra safe and expect life-changing results. Living it in cash, well, you lose to inflation. Pure stock portfolio, 8 to 10% is great, but it won't really transform your position, and in most countries, you will actually pay taxes when you withdraw those money. One single property with no leverage, too slow. So my mindset would be use 100K as a catalyst, not the final goal. I would aim to create leverage, build cash flow, most importantly, and target capital growth over the next 2 to 3 years. Yes, that means taking calculated risk. Honestly, if you already have 100K, well done. This is the hardest part. However, even harder becomes maintaining them and retaining and growing this capital, because really making 100K is the hardest first part towards building your wealth. However, after that, many are stuck on multiplying it or growing it steadily or even retaining it. So let's look at the scenarios that will actually help you to multiply it and grow it very smartly. Scenario number 1 is the high growth strategy and is focused on the Dubai market. This is what I would personally do if I wanted to push growth. Part A is obviously looking at the Dubai off plans for capital appreciation. I would allocate $45,000 to $50,000 towards finding a well-priced off plan in Dubai, and obviously that's not for the whole property value. The target deal would be a property priced at around 1.2 million dirhams. The down payment will be around 10%, so 120,000 dirhams. Then we have the DLD of 4% plus the property registration, and that would amount to around 53,000 dirhams. dirhams, and the total initial outlay is going to be around 173,000 dirhams or roughly $47,000. So why would I focus on off-plan? Is that because I don't need immediate income and I really want to focus on the growth. I want upside at the handover stage or even before. And most importantly, I want to lock in today's price, not the future price. But, and this is critical, only if the off-plan is priced below or comparable to the ready available stock. If not, I would personally walk away because in this situation, I only have 100K and I really need to know and believe strongly at 110% that this will work out. Some off-plans that will be more pricey or will have other amenities and that will basically push the price over the ready stock might not really play well for me because I only have this sum of money that will only work if I deploy it correctly and maximize the investment for every single dollar. So here you're not playing with multi-millions, so you need to really choose smart. This is where working with experienced off-plan specialists really matter. For this year, I've partnered back with WIM Real Estate, my go-to agency for off-plans in Dubai, with whom we worked in the beginning of the past year, 2025, and they focus specifically on high-growth, early-stage off-plans, not the hype launches, but projects that actually make investor sense. We've already had multiple successful cases with our past clients, and together we source properties not only in Dubai but also in Abu Dhabi and the neighboring Emirates. So if you want a calculated, low-risk investment and tailored guidance to choose the right off-plan here in Dubai and nearby, then check the links in the description and reach out to Wim right now. Alternatively, you can reach out directly to me or just leave some comments in the section below, and I'll make sure to help you with your property investing journey in the UAE. The second part of this high-growth number one scenario is to also get a studio, a ready one for Cashflow here in Dubai. So now we spent $47,000 and with the remaining capital, I would want income, not just waiting. That will also help me to diversify my portfolio and have some cash flow that will help me keep up with all the payments. So we would target a studio apartment which is already ready at around 650,000 dirhams. If you're a resident, the down payment is going to be 20%, and that will be roughly 130,000 dirhams. Then we have the DLD of 4%, which is 26,000 dirhams, and then the agency commission of 2% of around 13,000 dirhams. And all the other mortgage and miscellaneous costs will be, let's say, roughly 20,000 dirhams. So the total 189,000 dirhams or roughly $51,000. Next, you put it on long-term rentals. The rent will cover the mortgage, and hopefully you get a small or even a good monthly surplus. So a profit when you pay your mortgage that comes from the rent from your tenant. Equity also builds over time because every time you would pay your mortgage, or basically your tenant will pay you and then you pay the mortgage, you will also cover the principal, which is paying towards your property. This gives me capital appreciation. That's on the part A when you get the off-plan. Cash flow. That's on the ready studio that we've just discussed about. And most importantly, leverage. That's exactly how $100K will start behaving more like a 300,000 to 400,000. Now, I mentioned about the case when you are actually a resident and you can get a mortgage for 20% down payment. But what happens if you're not a resident? In that case, you can actually also get a mortgage at around 35 to 40% down payment. However, I think that will slightly go over our budget, so let's not focus on that, but look at alternative markets. So if I wasn't a UAE resident and I've already invested the 47,000 in the Dubai off-plan but can't access mortgages here, I would definitely look outside and adopt. As an example, we can look at Georgia, the country, at the real estate market in there. A one-bedroom apartment you can actually find at around $50,000. And let's take the case that you have to pay 50% down payment, which is $25,000. And let's also take around $5,000 in all kinds of miscellaneous costs for registering the property and so on. While this is going to be also an off-plan, so we'll also have to wait and to make and keep up with all your payments. When is ready, that's only when you're going to start actually renting it out and making some cash flow. I know that you can actually also get some ready properties also with payment plans in Georgia, but I'm pretty sure there are many other destinations where you can actually look at this. In the neighbor country of Azerbaijan, they also have this Sea Breeze project where you can also get some really good payment plan units, and not only off plan but also ready. So you basically pay the down payment and start renting it out right away and covering your payment plan. So definitely check out these locations, but also some other more remote destinations such as Sri Lanka or Thailand or Bali. Ask for the project details, ask for the payment plans, and try to understand if that makes sense for you. Now we've spent $47,000 on the first off plan in Dubai. Now the second, if you're not a resident, we spent around another $30,000 on this one-bedroom apartment in Georgia. So I have another $20,000 to $21,000 left. Well, in this case, I would diversify and I would look at a global ETF portfolio. I personally put it into Vanguard or BlackRock, and they have multiple ETFs that you can choose from. However, I'd target probably global equity ETFs that will bring me at around 8 to 10% yearly. This balances the real estate exposure, liquidity, and of course, global growth. Now let's look into scenario number 2, and that is for the medium risk and moderate growth. If I wanted less stress, here's another path that I'd take. First, I'd start with a ready property in Dubai, hopefully through the mortgage as a resident. If not, I would definitely get a mortgage as a non-resident. So it's going to be mortgage leveraged in a strong rental area, so I don't really have to stress from not finding tenants or from the area falling behind comparing to the other newer areas, and have some conservative appreciation. That will most probably take up the majority of my 100K budget. Then with the remaining amount of money that I've left, I'd invest the remaining cash into dividend and growth ETFs, and also reinvest all this income annually. Because let's face it, you can't time the market, so basically the best way would be to just put some money whenever you have it and you can actually invest every single time into those ETFs or those dividend portfolios, and that will help you to balance your exposure and also minimize the risk from the market going up and down, because you'll just be buying every month when the market is up or when it's down, doesn't matter, so it will balance out. Expected outcome in this second scenario, it's going to be 6 to maybe 8 or even 10% property yield from the rentals, 6 to 8% portfolio growth, maybe more in some cases, and very low volatility. This is ideal for professionals who want steady wealth building. Now, the last scenario, number 3, is the one for low risk and stable steady growth. If capital preservation was the priority, I would look into a smaller ready unit, no off plan at all, avoid it at all costs in this specific scenario, because you just want stable growth and don't want to have any kind of surprises or payments rising at any moment when the off plan is handed over. I look into a very, very high occupancy area, maybe where you can easily diversify into long-term, short-term Airbnb, so that you have some conservative leverage, but also you can cross-check any kind of situation if the market goes up and down. From the remaining money, if you have anything left, because I would probably buy this property fully or get a lower amount of loan so that I don't have too much risk in the future if the rate changes or anything. I mean, honestly, that's not my most favorite strategy in this case, because like I mentioned at the beginning of the video, 100K is really just a backbone that has to be multiplied. But honestly, if you don't want that and you just want steady income, very, very good growth, then you get the ready unit, rent it out, get some money, maybe some extra profits from your rent. And with the remaining money, you get into bonds and dividend ETFs. Target net return in this scenario should be at around 6%. Well, not very exciting, but it's stable. So if you want stability, then probably this is something that you're looking into. The real difference maker is the structure and the planning of it. Most people and investors don't fail because of the markets. They fail because they don't structure it correctly, don't plan cash flow, and don't think through exits. That's why I always tell investors the deal actually matters less than the structure of it. And even if you're super sure that this investment, let's say an off-plan, will definitely perform in the future, most important for you is to know your exit before you buy. So you need to know, are you going to resell it before handover, at handover, after? Are you going to maybe wait for the handover and furnish the property? Are you going to rent it out for long term, for short term, as in monthly rentals? Or are you actually venturing into Airbnb? You need to know this before you put any kind of money towards any kind of opportunity. And if you want help structuring your own $100,000, comparing scenarios, running numbers, or deciding between off-plan, a specific area, a micro location, versus ready properties that already perform and you have some data to actually evaluate and understand and predict where the property and how the property will perform, I offer one-to-one advisory calls where we break everything down around your situation. Check the links in the description. I have multiple offers around the advisory packages that I offer for both residents but also for non-residents. If you're someone who wants to relocate to Dubai or wants to set up your business in Dubai, I can also help with that. I've partnered with many company formations companies. So check the links in the description, reach out, and let's make your Dubai investment a success. As we can see, the 100K can be totally wasted. It can be parked. In the best case scenario, it can be actually multiplied. In today's environment, I'd use it to access better deals, better assets that might create leverage, build cash flow, and stay flexible. Most importantly, calculate your payment plans if you're going to venture into an off-plan investment, because you need to keep up with them so you avoid any kind of penalties in the future and enjoy the returns. Because Dubai still remains one of the only locations in the world where these scenarios work. And if you'll do it right, this 100K won't just be your biggest investment, it'll be the one that unlocks everything else. With that, I hope you liked the video. Please share your comments in the comment section below and subscribe to see more. And with that, I'll see you in the next one.